Hello and welcome to our first instalment of Technical Analysis 101, where we're going to be looking at indicators that market analysts and traders use to break down and analyse their financial charts. We are joined by our senior market analyst, Daniela Hathorn, who's going to be kind of talking us through some of the technical tools that you can use in your technical analysis. Now, I'm more of a fundamentals guy, as you kind of know.
Yep.
I know my rate hikes from my oil price spikes, but I know nothing about technical analysis. So you're going to be helping me with that today.
Yep.
What is the first thing that we're going to be talking about?
So we're talking about moving averages,
Okay.
which is one of the most basic indicators out there. It's great to start off with. It's very intuitive. It's easy to calculate. And I think it can set you up to then understand all the ones that come afterwards.
I mean, it says a lot that I don't know the most basic technical analysis tool. So so if you want to just start off by what is a moving average?
So the technical definition about a moving average, it's a statistics that captures the average change in a data set over a period of time. So with moving averages, essentially what it does is it takes the average of an asset's price over a period of time. Now you can determine the time period. They are usually predefined on a chart, but you can amend them to whatever you want. Usually you'll use days. So for example, 20 days, 50 days, 100 days, 200 days.
Yeah.
And essentially what it does is it smooths out an asset's price during that time period. And that gives you a little bit more of a comprehensive view as to how price has been moving throughout that time period, and also whether it's an upward trend or a downward trend. So that's essentially the basics of what moving averages are.
Okay, so what would you actually use a moving average for?
Yep. So as I said, moving averages are used to smooth out the price of an asset and to identify trends, especially to identify changes in trends. So for example, if you have an upward sloping trend and you start to see a moving average shifting in one direction or the other, then you could see that turning towards a downward sloping trend. So as I said, it's one of the most basics. All it does is averages out the price of an asset, and then you can interpret it in several different ways from then. And that's more the application of it on the chart.
Okay, so can you walk me through how moving averages are used with kind of some examples on the charts?
Yeah, I feel like with indicators, the best way to understand them is to see them on the chart and how they work. So this is a chart here of the pound against the US dollar, as you can see, also known as cable. So essentially, the candlesticks, which are these green and red bars, these are the price data. This is telling you how price has moved over the last day. It's a daily chart, so every candlestick represents one day.
Yeah.
If we zoom in a little bit more, you'll see these lines here. So we've got a green line, a black line, a red line, and a yellow line. Those are my moving averages. So if I pull this down here, you'll be able to see. So my 20-day moving average is the green line, then my 50, the black, 100 is the red, and 200 is yellow. You can customize this, as I said, by time period, also by color if you want. And essentially, they just come out on the chart here. And what this is telling me is essentially this green line is the smoothed out price of the last 20 days. This is a daily chart, so it's daily. If you go to a 4-hour chart, it will take the latest 24-hour periods. If you're on an hourly chart, it's the last 20-hour period. So it's taking whatever period you're on the chart, it's taking the last 20, 50, 100, or 200. And essentially what it's telling you is how price has performed over these time periods. So for example, here, the 20-day moving average is the green one. It's a shorter time period than the 50-day moving average, for example. So how these are used as an example, you can use them in two ways. You can use them in how they interact with each other. So for example, you can see here a clear cross of the 20, which is the green, above the black one, which is the 50. So this is a short-term average bullish cross. And essentially, this is just saying that in the short term, it looks like the most recent price data is suggesting more bullish behavior compared to the previous period. So when you have a cross of a shorter time period moving average above a longer term period moving average, essentially that's a bullish signal. You can see when that happened here, we did have GBP in a bullish scenario. So essentially that was suggesting that it's confirmed by this cross of the moving average. If you look at other ones, for example, you'll have the 100-day, for example. Here you've got the 20 moving across the 100. So you've got the green line moving on top of the red line. So this is even more significant because it's telling you that the shorter term period has crossed above the longer term, but not only the one previous in this case, so 50, it's crossed above the 100-day moving average. So essentially it's telling you that the short-term momentum is overtaking the longer-term momentum, and it's suggesting a bullish pattern is unfolding. So that is essentially how you look at them with each other. Another way to look at them is how are they interacting with price. So how are moving averages interacting with the price data, in this case the candlesticks? One very common way to use that is, you might not see very well because it's quite faint, but this yellow line is the 200-day simple moving average. It's generally used as a benchmark for support and resistance. So usually when price comes into contact with this yellow line, you often see a little bit of a retracement within that move. So for example, here you can see a bit of that. You saw that when the price came into contact with this moving average here, we'd seen a strong sell-off. It came into contact with this yellow line here, and we saw a rebound there. We saw a little bit of a rebound, and then that faded, of course. Attempted to break below it once again, found some more resistance also with that 100 days. So that was reinforcing that there was a lot of resistance for sellers to continue to push lower. And eventually what happens is we have a few tests of this moving average. And if there's enough momentum, we will eventually break it. And that's what happened here. But this is a way to use moving averages in relation to price rather than just how they interact with each other.
And what kind of styles of trading is this good for? Is it good for kind of long-term positions, short-term positions, you know, day trading? What kind of styles is it good
so
for?
the great thing about moving averages, they're customizable, right? So as I said, you can customize them to whatever you want. You can do minutes, you can do days, hours, weeks. So you can really customize them to whatever trading style you have. So generally, shorter time periods will be used for short-term trading, and longer time periods will be looking for longer-term trading. If you're looking at an intraday trade, other than potentially looking at 200-day moving average as a support or resistance level, as I said, you're not going to be really looking at it in terms of how it's interacting with other moving averages, because it's going to be way too lagged in time period in what you're looking for. So it is going to be just a case of adapting the time period to you. But also the great thing with moving averages is there's so many different variations of it. These are simple moving averages. We've got weighted moving averages, exponential moving averages. And these are just variations into how they calculate the price line. So, for example, exponential moving average is very common. Essentially, it applies more weight to the latter time period. So let's say a 20-day exponential moving average will apply more weight to the last few days of that 20 period than to the beginning ones, because essentially it's trying to say that what's happened most recently has more weight than what's happened 20 days ago. Whereas a simple moving average is just the arithmetic mean, so equal weight to every data point. The exponential moving averages applies more focus onto the latter part of that data set, because essentially it was trying to correct one of the disadvantages of moving averages, that it's lagged data. So, for example, some people prefer to use exponential moving averages for shorter time periods because it applies more weight to that most recent data, and therefore can be more useful in short-term trading. So there is many ways to customize it for different types of traders.
Okay, so if I just go back to the chart, so if you mentioned the bullish cross here, so if we were to see the kind of 20-day moving average come back down and the 50-day moving average, and then we cross again, would that be seen as a kind of bearish cross? So you would be looking for kind of bearish movement down rather than bullish movement up? Correct,
yeah. Again, one of the disadvantages of moving averages, and we'll have a look at all of them in just a second, is that it is lagged. It uses past data, and essentially it has a lag. And a lot of people say that by the time you've had this cross, the trend has already been confirmed. And you can see here, by the time we had the cross, we already had 2 days of this bullish move, which had actually started a few days prior. So a lot of the time it's more used as a confirmation within a pattern.
I see.
But it can also help detect potential reversos. So let's say, for example, you're seeing this sell-off continue, you have a little bit of a rebound in the next few days. So essentially you could be thinking, oh, okay, well, I still think, you know, this was just a retracement in price, a pause for breath, we're going to continue to go higher. If you then see the 20-day moving average dipping below the 50, that could start to suggest that, okay, maybe this isn't just a retracement, and we are going to continue to see that bearish that pattern continue. So you can, as I said, you can look at them in many ways in isolation between themselves with price. But it is important to keep in mind that it is lag data.
So how important is it in a kind of technical analysis toolkit? Because is it more of just a guide for potential other tools that you use? As you say, you use it as a kind of confirmation. So is it more of a, okay, you may have already thought this is going in a bullish direction. Okay, we've just seen that cross. Yeah, I was correct, and I've just kind of confirmed that move.
Yeah, I think with like any indicator, with technical analysis, it sometimes is used to confirm fundamental reasoning or views. But with moving averages, I think it's one of the most basic. It's very easy to have on the chart, as you can see. It's just, however many lines you want, but they're just lines that move in relation to the price. So I think it's quite common to have them on the chart. You don't always have to look at them. As you said, it can be used for confirmation if you have a reasoning to believe that, we're going to see a bullish spike because of X, Y, and Z, and you look at the moving averages and like, okay, what are these telling me? Do I think that, are they confirming? Are they dismissing my theory? Also, sometimes you could use them not so much to determine a trend, but to identify resistance and support levels. A lot of people use them for that. So I think it's probably one of the most basic. It can be used in correlation with pretty much every other indicator out there. And I think it's great to have on the chart to just get a feeling as to what the basic average of the price is telling you in terms of trends and resistance and support levels.
And are there some kind of key other tools that you would use in conjunction with it? So what, there would use it with the MACD or...
Yeah.
Tell me a little bit about that.
So the MACD is obviously one of them. I mean, it's moving average, convergent, divergent. So the MACD derives from moving averages. So yes, it's a great tool to use with them. Another one is the RSI. You can actually see it on the chart here. We can go more into depth about the RSI in another video. But again, you can use, for example, the RSI to look for a trend as well, or a period of overbought or oversold conditions, and use the moving averages to confirm or dismiss that theory. And a lot of time people feel that they have to use all the technical indicators out there, and I think sometimes it can get too noisy. I would recommend for any trader, especially a beginner, to find those two or three indicators that they find most comfortable and they understand the best, and just use those and use them together to see whether they're telling the same picture, whether they're contradicting each other, and that in itself can tell you so much. I feel like once you start to busy the chart too much, it gets a little bit overcrowded, and it's quite hard to interpret. But yes, I would say MACD and RSI are probably the most common, along with the moving averages.
Are there any kind of other notable drawbacks of the moving averages? Obviously, you mentioned that the data is lagged, but is there any other kind of, or is that the key thing?
Well, one of them is, and as I said, one of the main drawbacks of simple moving averages is that it assigns the same weight to every single price period, and the exponential moving average tries to correct that. So that can be avoided to some extent with the exponential moving average. Another one is that it doesn't look at the reasoning behind a specific move. So you could have an outlier in a chart, or a specific event that's driven a move, and again, that isn't assigned to that. And you have weighted moving averages where you can assign specific weights to different data points within a time series. So again, you can sort of overcome that, but generally they are viewed as very simple. And I mean, moving averages are that. They're very simple, and they just try and, it's kind of like a bit of an already digested piece of information. And sometimes simplicity can be, a bit of a negative here. So it's lagged. It doesn't assign weight to specific events unless you physically do it. And it kind of ignores the reason as to why you may have seen a price move.
Okay. And in terms of, you obviously mentioned, you can't kind of ascertain the weight of the price movements. Do you have to use it in conjunction with fundamental analysis? So would it be, if you're looking at the moving averages at the time of there's going to be a big rate hike or something like that, do you have to kind of look at both?
Yeah, I mean, again, this goes to the type of trader you are, whether you're more fundamental, more technical, or a mix of both. As I said, technical analysis in general can be used in conjunction with fundamental. It can confirm or dismiss a trend that you have identified. It can give you an entry point, an exit point, support and resistance. But yes, generally when you're looking at a chart, at least from my point of view, I don't look at it in isolation as just price trends with no context to it. I always look at the context. So if I know there's been a significant spike, whatever that may be, a specific event or something's happened, of course that's going to skew moving averages to an extent. And it's just, how do you think that event impacts the direction of price going from there? Is it something that has happened, has been corrected, and therefore the moving averages is smoothed out? Do you think it's having a significant impact and it's not really true to the technical view that the moving averages are giving you? So I think it's always great to give a little bit of context to a moving average or to any indicator on a chart.
Oh, well, thank you for that, Daniela. I've got a much better understanding of moving averages now. And thank you for watching. Join us next week where Daniela will be talking us through the Relative Strength Index, or the RSI.